So in this video, I'll explain the family guarantee and how that works and why you'd want to use this setup. So basically, if you wanted to buy a property, let's say it's the property that you want to buy here, and maybe you don't have a big enough deposit or you don't have any deposit or something like that, and you have a parent that owns a property, even if it's got a mortgage on it, that's okay, potentially, but they have a property and they want to help you out, then what you could be considering here is a family guarantee. And the way it works is when you buy a property or when you borrow money against a property, whether you're buying it or you already own it, basically the bank doesn't want to lend you more than 80% of the value of your property. So if this is your property here and we're looking at the value as a visual here, we can see that and this is the 80% value. So the lender isn't going to lend you more than this 80%, okay? Because for them it's too risky. Now, if you want to push this up to say 90% or 95%, then the lender may lend you the money, but they need more security. So they will make you pay for a lender's mortgage insurance policy. So that's what LMI is, lender's mortgage insurance. And that's because you're borrowing more than 80%, right? But even lender's mortgage insurance, you can't borrow 100%. That's too risky for even them. So if you wanted to borrow 100%, or if you didn't want to pay the lender's mortgage insurance, let's say you were only borrowing 85 or 90%, but you didn't want to pay a lender's mortgage insurance and your parents were happy to provide some assistance, then what they could do is provide a guarantee which allows you to go up to 100%. Okay. Potentially, depending on your situation. So let's say you were going to borrow 100%, but the bank's not happy with lending you more than 80%. So the bank wants some more security. So what they're going to do is go, okay, if the parents want to help out, then we need a guarantee from them. We'll lend 100% to you so you can buy your property, but the parents need to provide some sort of security so that if the kids don't repay, then there's some sort of recourse where the bank can come to the parents and say, hey, they didn't pay, you guaranteed this purchase. Now, how does that work? Well, basically, if I copy this and bring that over here, and we say that, you're borrowing 100%, then we want a 20% guarantee. Oops, this is not very easy to do here, is it? Okay, that's probably a bit too much. I'll bring this down just a little bit more. I want it to be about 20%. So that's about 20%. All right, so now we're going to go and provide a 20% guarantee from the parent's property. I'll change this to say, I don't know, blue, so we can distinguish. Okay, so now we've got an 80%, 80% plus 20%, that's 100%. So we've got a loan here of 100%, and the bank's happy to lend 80 without any security, but because the parents are coming in and they are providing a 20% guarantee on this loan, then the lender is more inclined to say yes to lending 100% of this property's value. Okay, even more, even they might even lend, let's say, 105%. Okay, let's bring this up. Now the bank's lending you 105% because you need to pay for stamp duty and things like that, right? So if that's the case, we're now at 25% above. So let's bring this thing up to a 25% guarantee, right? So it's as simple as that, right? Now, to make it simple, let's say that this property is worth $1 million, because that's an even number. That's easy to work with. And let's say the parent's property is also worth $1 million, just to keep it simple. Okay, so now this loan is $1,050,000, and this guarantee is $250,000. Does that make sense? It's just a percentage of the property's value. Okay. Now, what if the parents have a debt already on their property? Let's say they already owe 250 grand. Well, that's fine. All we do is go, okay, they owe 250 grand. Let's just go and move this up here. Put another one in here. Just have to bring that one below. Okay. Bring that one down here. Okay, so now it's a little bit off, but this should be 50%, right? So they've got a loan here already. Now that loan, even if it's another lender, is going to have the first priority. So it's down here. It's the first priority. Then the second priority is going to be this guarantee. So now the parents have got a 250 grand loan because 25% of $1 million. And they're also providing a 250 grand guarantee for the kids, right? So the parents' loan will continue on. They make repayments on a 250 grand loan. The guarantee, they don't make any repayments on the guarantee. It's not a loan, it's just a guarantee, right? It's just a promise. And the kids will pay the repayments on the whole $1,050,000. Okay, so that's how it works. We're just providing security for the lender. Okay, now what happens if the kids can't repay their loan and the bank has to repossess the property? Let's say 1 week later, which would never happen, right? There's so many steps. Let's do a more realistic approach. Let's say 1 year later, the kids haven't made any repayments on their loan, or not enough. They've only kept the loan at the same amount, so it's still $1,050,000, and the bank has gone through all the processes, and now it's come to the point where the kids aren't repaying the loan as per the agreement. So the bank's going to repossess the property. So what the bank will do is more than likely come to the parents and go, hey, it looks like we're going to have to repossess this property. And, because the kids aren't, meeting their commitments. And, is there anything you want to do with that? That potentially the lender could do that. And the parents could maybe go, okay, well, we could afford it. We can fix things up, right? So maybe the parents will help out and fix things up, okay? But let's say the parents go, no, can't do anything about it, sorry. And the lender goes, okay, no worries. Lender comes in and sells the property. But they've sold the property at a loss. So they only got $500,000 for it. So sold for $500,000, okay, because the property market has tanked or something, right? So the bank has now lost. The loan is $1,050,000. Okay, but now the property's only sold for $500,000. So now they're short $550,000, right? They've lost $550,000. Now the parents over here provided a guarantee of, remember, it was $250,000. So what the lender can now do is come to the parents and go, hey, we sold that property. Your kids weren't making repayments. We sold the property. We lost 550 grand. You provide us $250,000 guarantee. We want the 250 grand. Thank you. So now the parents have to come up with $250,000, whether they are able to take out a loan for that. That's fine. They can take out a loan, or maybe they can't take out a loan because their financial situation has crashed. Then the lender can now go after the parents for that 250 grand. So, if the parents can't pay up and everything goes completely south and there's no other way to fix it, then the lender could potentially take the parents' property and sell that to get their $250,000 back. Right? So that's how, in a nutshell, this family guarantee works. Obviously, I'm not a lawyer. I'm a mortgage broker, so I'm telling you I'm explaining from my understanding from a finance perspective. There's obviously a lot more involved. This is a legal agreement. So if you are considering this or you have a guarantee in place, don't take this as legal advice or financial advice. This is only from a mortgage broker's perspective. There's probably other things that the lender can and can't do in relation to this, but that's an overview of it. Now, what happens when, let's say that the property didn't sell? Let's say the kids have been making repayments, and now the loan is down to $1 million. They've been making repayments. It's now down to $1 million, and the property has gone up in value by, I don't know, $200,000. Okay, so now this loan is not at 105% anymore, is it? Because the value's gone up and the kids have paid off some of the loan. So let's say it's down to, let's say 80%. So 1.2 million. So 960,000. So let's say the kids have paid off the loan to 960. So we're now at 80%. Right? You see how that works? It's not just the loan amount, it's both the loan amount and the property value. So they've paid off their loan down to 960 and their property value has gone up to 1.2 million. So now their loan is only 80% of the property value. Once we get to that point, we can then say to the bank, hey, they've been repaying their loan as per the agreement. We've done a new valuation on the property and we notice it's 1.2 million and their loan is 960, so they now only owe 80%. We want to remove this guarantee. So now what we can do is we can apply to the lender and say, hey, can you remove this guarantee? Here's the evidence. So obviously we would take care of that for you. We'd organize a valuation. Obviously the bank can see how much you owe them. And then we apply it. And as long as this is all correct and as long as the bank agrees, obviously they need to agree with all of it, then they can choose to remove the guarantee. And then that guarantee gets removed. And now the parents are just left with whatever they had, without the guarantee, whether it's a loan or there's nothing owing at all. And that's how this whole family guarantee thing works. So I hope that makes sense. If you have any questions, just send me an email, support@godwinfinance.com.au. And I hope this is helpful. Thanks for watching.